Thank you very much, Steve.
My pleasure, Dale.
Thank you,
Have a wonderful
Blake.
evening.
Thank you, Steve and Morad. I'm going to make you the presenter now, and looking forward to hearing your voice and seeing your screen. And this will be my second interview with Future_Traders71. Looking forward to it. How are you, Morad?
Hey, can you hear me?
I can hear you clearly. Yes. How are you, buddy?
Good. How are you? Thanks
Good.
for having me on.
Oh, you're very welcome. I'm always appreciative after putting people through an interview if they're willing to come back.
I appreciate that. It's been a while, though. I think the last time we talked was probably, I don't know, 4 or 5 years ago or something like that. I don't remember.
Boy,
Yeah.
we're older. We're older and wiser, right?
Hopefully wiser. I can't guarantee that, though.
So then why don't you refresh my memory and give us, the community, an idea of how your trading journey started, how you got into the business, did you have influences, how did you end up being an S&P trader, Morad?
Okay, I'll try to keep it to 5 minutes.
Okay.
It's a long story, but I started out as an equities, high volume equities trader. I've always traded in a prop or arcade type of environment, meaning always around professionals who did this full time. I started down.
I never heard it called an arcade environment.
Well, when I first started, an arcade, the difference between a prop and an arcade is an arcade, they give you buying power and you get a desk and a computer and stuff, but you still have to put up the money. Whereas prop is risk-free, right? You're an employee, you get a cut of your profits, and that's it. So that's where I started, and then I switched once 9/11 happened and things kind of slowed down in the equity space. I got an opportunity to come up to Chicago and start to trade futures. And at a prop environment, meaning fully backed, fully supported, and with a cut of my profits. So I joined a group in the Chicago Board of Trade and started trading there. Also, basically order flow based, high speed, high volume scalping, so to the tune of around 2,000 to 3,000 round turns per day.
Wow. So is it like a quant and a black box algo?
No, it was all manual, just basically basically arbing the various markets from the Dow to the NASDAQ, ES, the DAX, and the FTSE and things like that. You just watched for movement, and this was pre high speed algo days, always on the screen. And then after a while, I started my own prop shop and started backing my own traders. And did that for some time. Had a very good success rate there. And then at around 2009, 2010, I decided to cut that down and do something else. But in the process, I moved from high-speed intraday trading, scalping, to building structures, to looking at market structures and context and things like that. And with the experience I had with my traders, developing people, actually watching people struggle through the process of learning why and how the market moves, through the process of getting that big light bulb and making the turn, and then finally managing their expectations and just churning away in a consistent way towards being a professional trader. So
yeah, it takes a lot of patience to do that. I know.
It takes a lot of things. It takes a lot of, that's the thing that I've run into. I mean, I came online in 2008 or 2009 and started tweeting, trades with a friend, and I didn't know how Twitter worked, but didn't know it was a broadcast. I was tweeting with someone in San Diego, and suddenly I started to see that I had, a couple hundred followers, and then 1,000 and 2,000 and on and on and on. So my focus has been to move from trading for myself and being kind of in my own little world to doing this in a more of a community, kind of the globe being the prop shop type of setting. And that's basically what I've been working on for the last 6 or so years. So, but I still, I'm a trader first, and I'm not an educator, although I've backing people, it's hard not to be. And my approach still is intraday. I look for, structures that are occurring intraday. I'm looking for, and I only trade futures. I stopped trading equities. Once I was introduced to futures, I never looked back at equities except for, investment type stuff. But intraday or day trading or professional trading, it's all futures. And it's everything from the ES to the DAX to crude to the NASDAQ, whatever happens to be moving and setting up is where I go. So depending on. So that's basically
good story. Interesting journey. So we're looking at is this an S&P chart here? No.
Yeah. So what this is?
Yes. So maybe you could explain some of like the black lines on the right and the profile lines on the left and
sure.
What you teach.
So this is a day session only chart, which means that this is looking, and I'm in Chicago, so those times are Chicago times, 1 hour, 1 hour behind New York or East Coast time. These bars represent a day session only or pit session only bar for the day, and this is the general overview chart. So this is my daily chart. I do not look on a daily chart at the overnight action, and the reason I don't look at the overnight action is because it is the S&P, and because it is built on the 500 equities that are in it. Those equities are not trading in their primary market overnight. I do refer to the overnight chart during my setup process in the morning, and I do this every morning at 9 a.m. Eastern. I do this thing called a trader bite. For those of you who are interested in sitting through it, it's on YouTube. It's live streamed. I don't charge anything for it. The point is to help people understand the market movement and structure. And what this chart is, it shows what we've done on a daily basis during the pit session. What you're seeing on the right here is what is called the composite profile. So what this is doing is it's plotting out the number of contracts traded at each price going all the way back to the start date of this chart in 2013. The start date of the chart is based on market structure. So the market might have dropped and then started to rise, and then I pick that as a bottom and I start to create a profile from that point onwards. And what this is showing and why it's important is bar charts show you the open, high, low, close. What they don't show you, and we I know there's a lot of focus on FX at F.A.C.E, but which doesn't have a kind of a global volume, consistent global volume presence because it's traded across many, many dealers. But in futures, there's only one exchange where a product gets traded, and each trade has a quantity. And so what we're doing here is plotting all the quantities that went off at throughout the bar, and we accumulate them to the right, and that's what's called a volume profile. The classic way to look at this is through market profiling. Here's a market profile chart. This is a classic chart, right, from back the Peter Stadelmeier days from the Board of Trade. But these letters represent half-hour bars. So if I split this profile, this basically shows, okay, during the B period, the market opened down here and it pushed up, pulled back, then it opened C period here, and each one of these represents a half-hour increment. So the market opens at 9:30, so 9:30 to 10, that's B period, 10 to 10:30, that's C period, and so on. So this represents exactly what a half-hour bar chart would. But what we do is we accumulate it to the left and start to see where the market actually spent time. That's what market profile does, and that's where I started when I started to look at setups rather than competing with the high frequency machines. I started with time, but then I have all this tick data. I have really accurate tick data. I want to see volume. And what volume does is it basically says, yes, you can look at a bar, you can look at the open, high, low, close, but where did the market really trade? Where did
people vote with their pocket?
Yeah, exactly. Because you might have a lot of votes here at the high, right? and very little in the body, which means that there was a lot of competition for this price, that this price was not competed, was competed for. It was not an excess high or an excess low. And so once I moved to volume profiling, I started to create this entire approach to it back in 2005, where I'm just studying not only the price action, but where did it happen? So it's almost like price is king. It dictates, that's what we trade. We trade price, we don't trade volume. But volume is the backup. It's the military. It's the execution. It is the force behind the auction. And that's basically what I'm looking at. I'm looking at the auction. How is the market auctioning? So my process does not involve any indicators other than the volume profile, which is not an indicator. It's just a way of presenting data. I don't look at any indicators at all. I don't look at moving averages or anything like that. I'm basically following the auction. So that's the daily chart.
So you're trading naked.
I'm trading pretty much naked. Yeah, I'm looking at.
All right. So do you trade from an office?
Yes.
Or your house? Because you should really only trade naked from your house, Morad.
I know, but the guys here are used to it.
With your drapes drawn.
The guys here are used to it, and my windows are wide open.
All right, buddy.
That's the daily, and then I break it down into the 15-minute, which is a day session only. So here it looks kind of noisy, but what I'm looking at here, the pink lines are areas that the market traded at the most. So the pink lines represent the prices where the market traded the most volume. And that's what's called a point of control, the volume point of control. So if you look at yesterday in the S&P, the most traded price of the session is 43.50, 43 being a key value down here. 43.50 got the most action yesterday. So I'm still seeing, just like everybody else, I'm still seeing that on a 15-minute bar chart. It opened at 48.25, it went to 49.25, then it started to move lower. We tested below the prior day's low and so on and so forth on a day session basis. But I'm paying attention to where that volume is going. Where's volume happening a lot? Those are areas of acceptance. Where's volume not taking place at all? Those are areas of rejections. Those are called low volume nodes. Like this area here, the 45 this morning is expected to be resistance. If we get back into yesterday's range, we're far from it. We're trading at 24.29 right now with 15 minutes left to the open. And we're leaving several days of trading behind. So we popped up last Tuesday in the S&P. We opened and we went trend up to 54. And then since last Tuesday, the low of last Tuesday and the high of last Tuesday, we've done nothing. Because we've traded inside every single day. Wednesday, inside of Tuesday. Thursday, inside of Tuesday. Friday, inside of Tuesday. Yesterday, Monday, inside of Tuesday. And now
let me ask you this, is there any way to tell, especially with the sideways range of all these inside days, whether or not it's accumulation or distribution by your volume studies?
So I'm not paying attention to, because in futures, there's an infinite number of contracts that can be traded, right? There's no float like you have in stocks. There's no limited inventory. So I cannot tell whether, everybody that traded this point of control yesterday was selling or buying, because for every buy, there's a sell. There has to be a sell. Right. Two people in the pit have to agree on a price for the contract to trade. What I do pay attention to, that proxies your question whether or not there's accumulation or distribution, what I do pay attention to very, very much, and it's the core of everything that I'm doing, is the market in balance? In other words, is it compressing? Is it agreeing on prices? The more the market agrees on price, and the more people say, hey, this is a good price for me to execute my hedge or to execute my position in the futures, the more likely the market's going to make a strong move away from there. So we see that a lot better on the weekly profile. So you look at what happened here. So these are weekly profiles. We're just looking at every day of the week. So if I split this up, this will show you every day of the week. There's Monday a couple of weeks ago, the week of the 7th, and Tuesday, Wednesday, Thursday, Friday. This is what the market accomplished during that week. We compress that back together, and we see that week, there was no agreement on price. The auction basically said, look, man, we are looking for that high. We're looking for those sellers when we went up there. So when we went and made all-time highs up here at 88.50, we were looking for those sellers. We found them. We found them on Tuesday. And then since we found them, we are not agreeing on price. It is an excess. We're not able to find those buyers anymore. We've only found sellers. So now we're going to sell off. We're going to start to sell off on Wednesday. And then on Wednesday, we tried to find those sellers again. We found them again, and we break lower on Thursday, and we broke lower on Friday. That was a couple weeks ago. But you look at the week before that, and I'm using this week as an example. Here's a market that is completely in agreement. This is a market that's what's called in balance or has consensus on price. Look at how much they traded at such a short range compared to the week after and the week before.
Yeah.
I'm looking for those. You can call that, you can argue that that's accumulation, but because it's a one-for-one, one buyer for every seller, all I'm interested in is, hey, this thing is balancing. And back then when I did the trader bite during that week, I kept warning that, hey, we are likely to have a big move out of here because this can only consolidate and compress for so long. As more and more people take positions in a tight market, there are more and more people who are likely to get stopped once it moves away from those prices.
There's your compression.
Yes, that's the compression, and then that's the expansion. And then the next week, we get compression early on, and then we get expansion later. So if I split this, you see this compression early on, and boom, there's expansion. Then we find a bottom. We usually reject the bottom because we're always looking for excess. Too much, it's too low or too high. Once we find that it's too low or too high, we bounce back up and we start to balance again. And we balance for a while until we get a new input, new information, North Korea perhaps, some change with the Fed or whatever, that tells us that the pricing in the S&P has to change once again. And that's what we do all the time. And that's basically auction theory, the auction process in a nutshell, except it's not theory. It's something that I use day in, day out to trade. So once I find out what my context or what the market's trying to do, I start to hone in on my trigger chart. And with my trigger chart, I start to monitor what's happening during the day. So yesterday, I start to look bar for bar. What is it doing? Okay, it found its sellers. It pushed up to 49.25. It found its sellers, and it keeps looking for buyers. And as long as it doesn't find buyers, it's likely to continue lower and lower and lower until it does find buyers. Once it finds buyers, we have a nice rotation, a large rotation up. Like here we see a large rotation down, 7 points from 49.25 to 41.50, 7 points or so. And then it has its rotation up. And now the question is, do we start to consolidate and then push through this high, which means that we have found our buyers and we are done with the bottom and we're likely to continue higher? And that's when I start to engage the market. I wait for these. I don't try to catch these big moves. That's not my bread and butter. My bread and butter is to find out who made the big move and what was the follow through. And if there's no follow through, I start to trade in a contrarian way. If the market is unable, if for example, yesterday it dropped, had a shallow pullback, and it continued to drop again with strength, then I'm only trading with the trend. But since we've been in balance for a couple days, I'm looking for a counter trend. I'm looking for it to continue to balance until it doesn't, which means I take a loss, and then that loss is my cost for finding out new information.
Okay, so how do you manage risk after your entry? Using this kind of method, when is your signal or whatever was compelling you to assume risk, negated. Is that your stop? You have to wait for your profiles to tell you something else is happening?
Well, I'm using price action with the profile backing up that information. I'm using price because that's what I trade. And then the volume profile just tells me where the trading is taking place. In this situation, so yesterday is not a great example, but we had what I call an impulsive move. Impulsive moves have a large rotation. This means that the market moved down 7 points without a single 7-tick pullback. So
Yeah.
it never rotated.
That's from point A to B faster.
Yeah, and that's an impulse. And an impulse generally gets a continuation. So you have this hard move down, then you have a small pullback, then you have a continuation, a lower low before the market starts to base again and correct. This is just classic price action, classic market rotation. So yesterday, the goal was to get short near that mid. Okay, didn't quite get there. It got there here. The mid is this blue line. The mid is just simply the high and the low of the day. The sum of the high and the low divided by 2. What's the middle? What's the 50% pullback on the entire day's range? I track that, and I'm leaning against it. So the entries right here, I immediately look for a 2-point scale out because my task as a trader is always to mitigate risk. So I'm not here to catch, on a 20-point move, I'm not here to catch 19 points.
So you take partial profits after you're in the money, 2 handles.
Absolutely, 2 handle, and then that gives me room. That gives me a new average to work from because now I've got money in my pocket that improves my entry. And then I start to manage it with what I call zippers, these small consolidation areas that basically say, hey, the market's in consensus and it's trading tight, and then I look for those to break. So that's how I'm managing risk. I'm always looking, actually, the tool that I need to show you to manage.
And that's a Renko chart back there, isn't it? Is that Renko?
That is a Renko chart. And the only reason I use Renko is because if nothing's happening, I don't want a bar. I don't want these little dots. So
I use you use the tails on the Renko. A lot of people don't use tails at all, do they? Using Renko?
They use bricks. They don't use the tails. I do want to see the tails because I want to see where the excesses are. So it's a candlestick, but it's using a Renko in terms of how far the market has to move before another bar is printed.
Okay, got it.
And my entries and so on are all occurring on this order flow platform, and I'm watching. So, for example, let's say I'm short this trend down here in the S&P. I'm watching where did the market consolidate last. So the market consolidated last. If I'm short, say, up here, I can't draw on this because it's a live chart. It doesn't leave the line. If I'm short down here, and then the market pulls back, okay, I'm going to start using this little pullback, this consolidation, this fight that you see here between the buyers and sellers. I'm going to start using that to control risk, because if I'm correct, if I'm right, then the market's likely to have the energy to continue as it did here. If I'm wrong, it's likely to push through this battle zone, and at that point, I'm looking at getting out. I start to work my position. If I'm short, I'm starting to work bids to start to lighten up the position back to scratch. I'm managing trade in an active way. I'm not recommending this, but I'm on a fiber optic line.
You don't use stops, do you, Morad?
I don't, but I don't recommend it, to trade at your own risk type of thing.
You use mental stops. The last time I used a mental stop, my first stop was a mental institution. You ever hear that one?
Yeah, I heard that. That came to me from my bond trader in the pit.
Yeah.
The reason I don't use a stop is because I don't recommend it. You have to have, in order for you not to use stops, you have to have good psychology, good discipline. Yeah. And the reason I don't use a stop is because once I put a stop on, I'm just watching that stop getting hit. I'm not staying active with the auction, which is the whole approach of my trading. I do recommend a disaster stop no matter what. Like, I suggest that you have a platform that once you get short or long, it throws a 10-point stop in case the market goes haywire and it's too fast for you. You don't want to lose your whole account on one trade.
Good
but
advice.
I'm managing risk. Yeah, I'm managing risk actively. Anyway, that's a lot to digest.
Yeah, great presentation. If you'd like, you can show your website and how people could follow up with you, get in touch with you if they're interested.
Sure.
And so you still work with traders, or you're not from a prop basis, but just using your software. Am I correct?
Well, I was part of a brokerage that was started in 2012 called Stage 5 Trading, and the idea is to bring brokerage, just your normal competitive online brokerage, but to create a community out of it. So there's a chat room and there's webinars, weekly webinars and things like that. And the idea is to slow traders down, which I think is the biggest caveat. People put money in and they just want to trade, and they don't give enough time to themselves to form an opinion and to actually gain experience, right? So that's
you can't learn it. You can't learn it. It only comes with time.
Exactly. You can't push through it just by taking bets all the time.
Yeah, you have to live through stuff. So go ahead.
Yeah, if you want to get a hold of me, just futurestrader71.com, and also you can find me on Twitter. I interact with people a lot on Twitter at twitter.com/futurestrader71. And if you have questions, just hit the contact button and just drop me a note, and someone here will try to answer you. Pretty soon, in the next couple of months, I'm releasing what's called a trader development program, which is the first step towards getting back into prop, where I'm making the training program for a prop firm available to the public, as opposed to just kind of a theory. It's more of exercises and things like that. That's coming out in the next couple of months, hopefully.
Are you in the Board of Trade building?
I was until a couple of years ago. I'm down the street, but I'm still in the financial district of Chicago. I'm still in the loop.
I started as a runner at the old Merc under Union Station a long time ago. So last time I was there, the floor looked like a bowling alley.
It is probably a bowling alley right now, or an ultimate fighting ring or something. There's
no edge anymore of going down there, is there?
No, there isn't. Most people are trading on, tablets anyway, and they're just arbing the pit. But there's not enough volume in the pit anymore to.
Only the options pits were busy when I was there.
Yeah, and the STIRs, the short-term interest rates, are still pretty busy in the Board of Trades. Other than that, there's really no point in holding a seat and being down there.
Have you been converted to being a Bears fan?
I am a Bears fan. I like to play sports. I don't like to kind of go through and follow every little step that the team is taking with trades and everything else. All
right. I was just going to prepare you for the heartbreak of being a Bears fan. So
I think heartbreak is part of being a Chicagoan.
It is, except the Cubs finally rectified everything
after a century.
Yeah, so that was a pretty big cycle. I want to thank you so much, Morad, and
I appreciate you having me on.
People could follow you at future singular, no S _71 on Twitter. And
it's Futures Trader 71. There's no underscore. It's just one word, Futures Trader.
Oh, really? Okay. All right. I appreciate that, and thank you so much for your time and very interesting approach. And I could tell you're a pro, and thank you, my trading warrior brother. I hope your profiles make pips and points and everything rain down on you and your associates.
I appreciate it. Take care. Thanks for having me.
All right.
Bye.
That was Futures Trader 71. Kevin, you're welcome. Okay, so that was Turnaround Tuesday. Everyone doing okay? Enjoy it? Let me just take a quick look at the markets. DAX is coming off. Let me give it to me. Just see what's happened during the interview. Gold still strong. Just want to take a look at a couple of things I talked about. 62.50. Yeah, it's trying. Pound Aussie is trying. I also talked about Aussie yen. Okay, it is starting to fail from the 660. I'm with Steve on this one. I think we take this low out. And I don't know what else I really talked about. Euro yen is backing off a little bit. Still think that we need a stop hunt over this high. Could end up being a classic 3 drive here in Euro yen. It's now on Forex Stop Hunter's radar screen. Everyone have a great afternoon. Enjoy the rest of your summer day as we approach fall. My gosh, we're only a month away. Has everyone had a good summer hanging out with Blake and Steve and Greg and Nick and me and Stel? Have you enjoyed your summer? We've enjoyed hanging out with you guys. I think you'd enjoy it a little bit more if you just click the, thank you, Mauro. You just click the link and try out ForexAnalytix, because things will happen, I guarantee you, after this session. You're very welcome, Michael. And remember, most of all, don't just count your pips, count your blessings. And we'll see everyone tomorrow. I have a gold guy coming in here tomorrow, so be around with what's happening in gold. His name is Bill Downey at goldtrends.net. So you know what guys in the gold business say? They say, don't wait to buy gold and wait. See everyone tomorrow. You're very welcome, Andrea. Thank you, Steve. Thank you, Blake. Thank you, team. Thank you, Velu. Thank you, Stel. Adios.